In 1997, Thailand ran out of dollars. Not metaphorically, literally. The central bank vault was empty. Within 3 months, the Thai baht collapsed by 40%. Millions lost their jobs, and the entire economy imploded. But here's the part that doesn't make sense. Thailand hadn't been irresponsible. Their budget was balanced, inflation was low, growth was strong. By every traditional measure, they were doing everything right. So what actually went wrong? The answer involves a system so fundamental to how the modern world works that most people have never heard of it. It's not a conspiracy. It's not controlled by a single government or institution, and yet it quietly determines which countries get to develop, which ones stay poor, and which ones collapse without warning. This is the story of global dollar liquidity, and once you understand how it works, you'll never look at international economics the same way again. Let's start with something simple. When you buy something from another country, you don't pay in your currency, you pay in theirs. Or more accurately, someone somewhere converts your money into theirs. Most of the time, that intermediate step happens in dollars. The US dollar isn't just America's currency, it's the currency of international trade itself. Roughly 60% of global trade invoices are in dollars. About 90% of foreign exchange transactions involve dollars. Half of all international loans are denominated in dollars. And here's where it gets interesting. About 2/3 of all dollar transactions happen outside the United States. Every day, trillions of dollars move between banks in London, Tokyo, Singapore, and Frankfurt, settling trades that have nothing to do with America. This creates a strange situation. Countries need dollars to function in the global economy, but they can't print dollars. Only the US Federal Reserve can do that, which means every other country in the world is dependent on a supply of currency they don't control. Now, under normal circumstances, this works fine. Dollars flow out of the US through trade deficits, tourism, military spending, and foreign investment. Countries accumulate reserves. Banks hold dollar deposits. Everything hums along. But the system has a vulnerability that most people never think about. What happens when dollars stop flowing? Go back to Thailand in 1997. Throughout the early 90s, dollars had been pouring into Southeast Asia. Investors loved the story. High growth, cheap labor, emerging markets. Thai banks borrowed dollars from international lenders and converted them into baht to fund local construction projects, real estate developments, and business loans. It was a gold rush. But there was a structural problem baked into this arrangement. The Thai baht was pegged to the dollar at a fixed exchange rate. That meant the government promised you could always trade baht for dollars at the same price. It was a promise that required one thing: enough dollars in reserve to back it up. By 1997, that promise was breaking. Foreign investors started to get nervous. Maybe the real estate market was overheating. Maybe the loans were riskier than they looked. Slowly, then suddenly, they started pulling their money out. Dollars flowed out of Thailand faster than they were coming in. The central bank tried to defend the peg. They sold their dollar reserves to buy baht, trying to hold the exchange rate steady. But reserves aren't infinite. Once the market realized Thailand was running low, it became a race. Everyone tried to get out at once. The peg collapsed. The baht went into free fall. And because Thai businesses had borrowed in dollars but earned revenue in baht, their debt burdens exploded overnight. Companies went bankrupt, banks failed. The crisis spread to Indonesia, South Korea, Malaysia. This wasn't about bad policy, it was about liquidity. When the supply of dollars tightened, the entire structure came apart. Here's the uncomfortable part. This pattern keeps repeating. Argentina, Turkey, Lebanon, Sri Lanka. The details change, but the mechanics are the same. A country becomes dependent on foreign dollar financing. Investors get nervous. Dollars flow out. The local currency collapses. Debt becomes unpayable. The economy implodes. And it's not just emerging markets. Even developed economies aren't immune.
During the 2008 financial crisis, European banks were on the verge of collapse because they couldn't access dollar funding. They had massive dollar-denominated assets, but suddenly no one would lend them dollars. The Federal Reserve had to step in and create special lending programs, currency swap lines, to inject dollars into the global system. Without that intervention, banks in France and Germany would have failed. The financial system recovered. Most people forgot it happened, but the underlying fragility never went away. So why does this system exist in the first place? It's a legacy of World War II. In 1944, representatives from 44 countries met in Bretton Woods, New Hampshire, to redesign the global financial system. Europe was in ruins, currencies were worthless, trade had collapsed. They needed a stable anchor. The solution was to make the dollar the center of everything. Other currencies would peg to the dollar. The dollar would be backed by gold. And because the US had the largest economy and most of the world's gold reserves, everyone trusted it. That system technically ended in 1971 when Nixon took the dollar off gold. But by then, the infrastructure was already built. Oil was priced in dollars. Commodities were traded in dollars. Debt was issued in dollars. Even after the gold link was severed, the world stayed on a dollar standard, not because anyone decided it should, but because switching would have been too complicated and too expensive. So now we're stuck with it. And the weird thing is, the US didn't really plan for this. American policymakers sometimes talk about the exorbitant privilege of having the world's reserve currency, but it's also an enormous responsibility. Every time the Federal Reserve raises interest rates to fight inflation in the US, it tightens dollar liquidity globally. Currencies weaken, debt becomes harder to service, crises pop up in countries most Americans have never thought about. The Fed doesn't set policy for the world, but its decisions affect the world anyway. Let's talk about what this means right now. Over the past 2 years, the Federal Reserve has raised interest rates aggressively to combat inflation. That's made borrowing dollars more expensive everywhere. For countries that rely on dollar financing, the pressure is building. Egypt's currency has lost half its value. Pakistan needed an IMF bailout. Ghana defaulted on its debt. Zambia, Ethiopia, and Tunisia are all in negotiations with creditors. These aren't isolated incidents, they're symptoms of the same underlying condition, a shortage of dollars in the global system. And here's the twist: the more countries struggle, the stronger the dollar gets. Investors pull money out of risky markets and move it into US assets, which they see as safe. That makes the dollar even more expensive, which makes the debt burdens even heavier, which causes more countries to struggle. It's a feedback loop. Some economists call it dollar hegemony, others call it a design flaw. Either way, it creates a strange world where the strength of the US economy can destabilize everyone else. Now, people have been predicting the end of the dollar system for decades. After the 2008 crisis, there were serious conversations about creating a new global currency or shifting to a multipolar system with several reserve currencies. China has been pushing to internationalize the yuan. Russia has tried to build alternative payment networks. Some countries have explored settling trade in their own currencies. But none of it has really worked. The dollar still dominates, not because of military power or political pressure, but because of inertia. The infrastructure is already there. Contracts are written in dollars. Debt is issued in dollars. Markets are deep and liquid in dollars. Switching would require coordination on a scale that's almost impossible to imagine. So now we're left with a system that everyone complains about, but no one can replace. And the longer it continues, the more fragile it becomes, because the global economy keeps growing, but the supply of dollars doesn't automatically grow with it. The US runs trade deficits to supply dollars to the world, but those deficits create political tension domestically. If the US ever balanced its trade, the global dollar shortage would get even worse. It's a paradox. The system requires American deficits to function, but American deficits are politically unsustainable. Here's what keeps financial historians up at night. Every global monetary system eventually collapses. The gold standard broke during World War I. The Bretton Woods system collapsed in 1971. The current dollar system has lasted longer than either of those, but that doesn't mean it's permanent. The question isn't whether the system will change, it's what happens during the transition, because these shifts don't happen smoothly. They happen in crises. Currencies collapse, trade freezes, wars sometimes follow. And we might be closer to that point than most people realize. Central banks around the world are buying gold at the fastest pace in decades. Countries are experimenting with digital currencies. The geopolitical consensus that held the system together is fracturing. None of this means the dollar will disappear tomorrow, but it does mean the invisible architecture that holds the global economy together is under more stress than at any point in a generation.
The next time you hear about a currency crisis in a country you've never visited, remember, it's not just about that country's policies. It's about a system that makes the entire world dependent on the decisions of a single central bank in Washington, D.C. A system that works beautifully when dollars are flowing and catastrophically when they're not. Thailand ran out of dollars in 1997. The question worth asking is, who's next? And maybe more importantly, what happens when enough countries run out at the same time? That's all for this video. So if you found this video gives real insights and add on to your knowledge, then like, comment, and share with others, and subscribe the channel for the amazing content coming your way.